Hello and welcome to today's webinar. We'll be getting started shortly. We're just waiting for the viewers to join. Okay, great. Thank you again. Welcome to today's webinar. Today's session is a very popular topic. We field questions on this topic regularly, so we thought it would be helpful to post a webinar about it. Specifically, we're going to be going over how to add or include a spouse to an owner-only plan, like our solo 401k plan. And so I would ask you to please like this video. Please subscribe for more videos like this. Please let me know if you have any feedback on the audio, if you're watching this on a live session. Please ask questions in the chat and I'll answer the questions as we go through the slides. If you're watching this on a recording, you can ask questions in the comments and we will respond to those questions within 24 business hours. So we'll go ahead and get started. It's like we might have lost audio here. I think we're back. So again, the topic of today's discussion is adding or including a spouse to an owner-only solo 401k plan. This screen gives us a nice roadmap of some of the great topics we're going to discuss. So some of the features or highlights, things to consider when you're thinking about adding a spouse to a plan, the eligibility to do so, and the basics, the mechanics of how to do so, how to get more information if you have follow-up questions. So in terms of some of the highlights, when you're thinking about adding a spouse to a solo 401k plan, and just to set the stage, of course, a solo 401k plan is for somebody who's self-employed with no non-owner or non-spouse employees working in their business. They're able to set up a retirement plan, a solo 401k plan for their business. And so sometimes we field inquiries from clients or prospective clients who might have their own business and they want to find out about adding the spouse to the plan. So the spouse can have their own solo 401k account, etc. So one of the main issues to consider is contributions. So that's our first item that we want to highlight. So both, and I'm sorry about the technical difficulties. We'll recap that. So both spouses can maximize contributions to the plan based on each spouse's own self-employment income. So for example, if you have one, let's say it's a self-employed business that's taxed as an S corporation, one spouse can contribute based off of their wages. And then the other spouse can contribute based off of that spouse's W-2 wages. So it's based off of each person's own self-employment compensation. It's also based off of each person, the other factors like the age of that other spouse, whether that spouse is making contributions to another plan. But assuming that each spouse has the self-employment income to justify it, each spouse can contribute up to the overall limit, which for 2021 is $58,000. So theoretically, you could get almost $120,000 into the plan if both spouses are maximizing, or even more if both spouses are 50 or older, because it could be up to $64,500 for each spouse. The second item to highlight is loans. So one of the most popular reasons that people set up accounts with us is because they want the ability to take a 401k participant loan. So our IRS approved plan allows for taking a 401k participant loan. So you, of course, have to satisfy the requirements. So you can't borrow more than 50% of the balance, not to exceed $50,000. The loan has to be documented on loan documents like a payment schedule, amortization table, promissory note, etc. So a common question comes up, well, how much can each spouse borrow, right? So just like the ability to contribute is based off of each spouse's self-employment income and the other factors. The ability to take a loan is analyzed at the spouse level. In other words, each spouse can borrow up to 50% of their specific balance. So if one spouse has $200,000 and the other spouse has $50,000 in the plan, the first spouse could borrow 50% of the balance up to $50,000. So that's first spouse could borrow $50,000 because they have $200,000, or the value of the assets in the plan is equal to $200,000. The second spouse can only borrow $25,000 because that spouse can't borrow more than 50% of their participant balance. And so then each spouse would pay it back to their own respective accounts. So, they would have separate sub accounts as part of the initial establishment process. They'd have their money in separate accounts. They would borrow from their respective accounts and pay it back to their respective accounts. The third item to highlight is, really just more about the ability to take a loan. Then number two here, just about both being able to participate in the plan. So that's really just more focusing again on, assuming that they're both self-employed. So they both need to have the self-employment income to justify their participation in the plan. So they would, for example, if the business is taxed as an S corporation, they would each receive W-2 wages. If the business is taxed as a partnership, they would each receive a K-1 with line 14, self-employment income reported on the K-1. Or they would each receive a Schedule C or file a Schedule C. So depending on how the business is taxed, the key is that each person is reporting their own self-employment activity. In that case, each spouse is able to participate. So what does that mean? That means that each spouse has their own account, or each spouse might even have multiple sub-accounts. For example, if each spouse has pre-tax money and Roth money and even voluntary after-tax money, then you're going to have a situation where you have 6 different sub-accounts, a pre-tax, a Roth, and an after-tax for each. The fourth thing that we're highlighting on this page is that both can invest in alternative investments. So another popular reason why clients set up accounts with us is because they want the ability to invest in an alternative investment, whether that's real estate, notes, cryptocurrency, precious metals, stocks, mutual funds, whatever the case may be. And so each person has the ability to control what they are going to invest in. So in other words, one person might invest in crypto and the other spouse wants to just invest in the stock market. And that's okay because they have different accounts. You could have one account at a brokerage, the other person has an account at a cryptocurrency exchange, and that's perfectly acceptable. And I see that we have a comment. I appreciate that comment. Thank you so much for asking it. So we'll go ahead and field it now. Does earned income have to come from the business tied to the solo 401k? Is it from any self-employed income? That's a great question. So you can really aggregate. A lot of people have multiple streams of self-employment income. Let's say you've got a person that's getting a 1099 miscellaneous, and they also have another small online shop, and everything is done via a single member LLC or as a sole proprietor, and it's all flowing onto that Schedule C. So that person would be able to use all the sources of income that flow onto that Schedule C to justify participation in the plan, as well as make contributions to the plan from their self-employment income. So great question. Thank you so much. Don't hesitate to ask more questions. So now we're going to dig a little deeper into each of these topics. So highlight number 1, maximize contributions. Each participating spouse can contribute. So here we've got the overall limits. So if the plan had been set up before December 31st, 2020, on or before December 31st, 2020, the individuals are going to be able to make contributions based on their self-employment income that they report in 2020, as well as the other factors, like whether they make contributions to another plan, their age, etc. For 2020, the overall limit is $57,000 or $63,500 if you're 50 or older. For 2021, the limits go up to $58,000 or $64,500 if you're 50 or older, because you've got that $6,500 catch up. And we've got some great deep dive presentations. If you subscribe to the YouTube channel, you can see all the different webinars, and we go into great detail on how to make contributions depending on how your self-employed business is taxed. So please don't hesitate to check those out. Highlight number 2. So here we want to highlight that it's the same solo 401k plan. So even though you've got multiple people participating in the plan, it's just one plan, one fee, that we charge, but different sub accounts. So it's because really it's one business that's sponsoring that one plan, but it can accommodate multiple participants as long as they're spouses or both owners. So the technical term for a solo 401k is a one participant plan under the rules. But one exception to that one participant requirement is for spouses that work in the business and report their own self-employment income. So if the other spouse is going to participate in the plan, then the spouse though needs their own separate holding account or participant account. So let's go to the next slide to see an illustration. And we talked about this a little earlier, how you might have 6 different sub accounts. So we've got Jane Doe, John Doe. Their business sponsors XYZ Trust. So Jane has a pre-tax account, a Roth account, and an after-tax account. John has a pre-tax account in the name of the plan for his benefit, a second Roth account in the name of the plan for his benefit for his Roth funds, and then a third account in the name of the plan for his benefit for after-tax funds. And you may be asking, why would they have 6 different accounts? And that's typically going to be because in this situation, they're trying to take advantage of the Mega Backdoor Roth contribution strategy. And again, we've got tremendous webinars and content on the website that goes into great detail about how that works. But focusing on the spousal participation issue, the key takeaway here is that each spouse has their own separate account or accounts if they have different types of money. So great question. Thank you. Can the spouse contribute their W-2 income from the business only, or W-2 income from their other full-time employer too? The answer is no. You can only contribute based on your self-employment income. So you can't take wages that you earn at a day job, even if that day job employer doesn't offer a 401k plan, and then use that as a basis to make a contribution to the solo 401k. So thank you for that good question. So now let's dig a little deeper under the participant loans. So again, one of the main reasons that people set up accounts with us is because they want to be able to borrow from the plan. That's where you're literally taking money out of your own retirement account, but it's not considered a taxable distribution as long as you satisfy the participant loan rules. And so those rules are going to apply at the participant level. So each participant can borrow from his or her respective solo 401k balance. So, like on the prior slide where each person has their own separate account. So spouse number 1 is taking the money from spouse number 1's account. Spouse number 2 is taking it from spouse number 2's account. So the most that you can borrow is 50% of your balance, not to exceed $50,000. So if your balance is $50,000, you can't borrow more than $25,000. But if your spouse's balance is $150,000, that spouse can borrow up to $50,000, because $50,000 is less than the 50%, $75,000. You can't go more than $50,000. And then, of course, that loan has to be, just to put a little more meat on the bones, the loan has to be paid back to each person's account. It has to be paid back either monthly or quarterly, equal payments of principal and interest, with those payments spread out over a 5-year term, unless you're using the money to buy your primary residence, in which case you could have a longer term, 15 years or even 30 years. Now, another great reason that people set up accounts with us is because they want to invest in alternative investments, like, let's say, real estate. So that would be a great example of where spouses will want to pool their money together. So in this case, let's say you have they want to buy a piece of real estate for $100,000. You have two spouses. One spouse has $60,000 that they want to invest. The other spouse has $40,000. So the property needs to be purchased. And I see we have another question. We'll finish this slide and then we'll answer that question. Thank you so much for asking that good question. So the property needs to be purchased in the name of the plan. So there's just one plan, right? One plan, one business, one fee, but different accounts, different participants. So the title to the property would be taken in the name of the plan. So on the title, you don't show who owns what percentage within the plan. That's handled at the plan level. Now the money would transfer the money to purchase the property would transfer, say, to the escrow company from each person's respective accounts. So spouse number one is going to transfer $60,000, say, to the title company or the escrow company to buy the property. Spouse number two is going to transfer $40,000. And so the ratio that the spouses own the investment is reflected and handled in the solo 401k plan documents and at that level. So going forward, for administrative ease, you could have all of the money related to the income and expenses related to that investment. Let's say it's a rental property. So your tenants are not going to write two checks. They're not going to write, if it's $1,000 per month to pay the rent, they're not going to write one check for $600 and a second check for $400. They're just going to just write one check for $1,000 payable to the plan. So that's income. It needs to come back to the plan. So for administrative ease, the money could just go into one of the two participants' accounts. Likewise, expenses need to be paid by the plan. So if the toilet breaks under the solo 401k real estate investment rules, you cannot work on the property, you can't stay on the property, you can't use it for personal use. So if that toilet breaks, you can't fix it yourself. So you would pay a third party to fix it using the solo 401k funds. So you could pay for those expenses out of that same account that you're using for administrative ease. But ultimately, you're going to need to reconcile between the two accounts. So the net funds would be split 60-40. And you definitely would want to do that at least on an annual basis, and certainly before you took any type of distribution. So thank you again for the good question. So you say, is it 50% of your aggregate balance across pre-tax, Roth, and after-tax, or just one of those accounts? Good question. So let's go back to the illustration. I think this is going to help us understand it. So let's say that one of the participants, like in this situation, Jane, she has, let's say, $40,000 in her pre-tax account and $60,000 in her Roth account. So Jane can borrow up to $50,000. So for purposes of figuring out how much she can borrow, you look across the whole plan. So she can't borrow more than 50, but she can go up to 50 because her total value of her plan is 100,000, right? We said 60 in one and 40 in the other. And she could actually take the full 50 out of just one. So even though she has only 60 in her one account, because she's got $100,000 of plan assets, she could borrow the full 50 from that one account. Now, let's say she wanted to borrow 25 from one and 25 from the other. So in that case, it would actually be documented as two separate loans because the pre-tax money needs to be paid back to the pre-tax account. The Roth money needs to be paid back to the Roth account. And if she takes them on different days, then she's going to have different payment schedules. And of course, that'll be documented on the loan payment schedule. And she'd have to be on top of that to pay it back to the right account and by the payment deadline. So hopefully that answers your question. So moving on to another great topic area, which is eligibility. So here, first of all, we want to emphasize that, again, putting it in context, the solo 401k is a one participant plan, but there are exceptions. One is for a spouse, but the spouse needs to be working in the business and reporting his or her own self-employment income, whether that's Schedule C, W-2, line 14 of the K-1. Of course, the business cannot employ other full-time non-owner employees. And then another key thing to remember here is the controlled group rules. So let's say that one spouse is a CPA and has 100% ownership of a CPA business that has full-time non-owner W-2 employees. So the other spouse, let's say the other spouse has another business and the two of them own this other realtor business, which doesn't have any employees. So a common question is that, can the realtor business, and let's say both spouses work in the CPA business, just to be clear. So two businesses, one is a CPA business with employees, the other one is a realtor business with no employees. So a common question would be, hey, could we set up a solo 401k for our business with no employees? And the rule is no, because the ownership interest is going to be those two businesses, the ownership interest is going to be attributed under the family attribution rules, which apply to the controlled group rules. So under those controlled group rules, those two businesses are going to be viewed as one unit. And so that means that effectively all the employees that work for the first business, it's going to be treated and analyzed as if they work for both businesses. And so neither business can set up a solo 401k. So there are exceptions. And if you don't own 100%, the controlled group rules may not apply. You also need to consider the affiliated service group rules. So things can get a little complicated. So it's definitely something that you would want to review with your tax advisor if you do have an ownership interest in another business with employees. But if that doesn't apply to you and you're both working in the business, both reporting your own self-employment income, it's going to be very straightforward. No full-time employees. You're going to be able to set up a solo 401k. And like we said before, it'd be one plan, one fee. You can both participate, subject to all the good topics that we've been going through. So before we shift gears, we've got another good question here. Does the spouse have to be an employer of the LLC to participate in the plan? Or can he participate just to manage the plan as the administrator? So that's a great question. And so I understand what you're asking is whether or not can you have the spouse just there to say help manage the account, but not actually have any of their own money. So you can add even if your spouse is not reporting his or her own self-employment income, they can still be on the plan in the capacity of a co-trustee. So as co-trustee, just a co-trustee only. So for example, when you're signing up for our plan, one of the questions we ask you is whether or not you have another spouse that's going to be participating in the business. So the answer might be no, but you might say, I do want my spouse to have signing authority to help me, to your point, administer the plan. And so that's certainly acceptable. You could have the other spouse added as a trustee. They will have signing authority, but they wouldn't have their own separate account. They wouldn't have their retirement money. They wouldn't have to worry about it. And to have your spouse as the co-trustee, they don't need to be reporting their own self-employment income. They can they're just a co-trustee only. So you would just enter the name, put co-trustee only on the application so we understand what you're trying to do. And I see you've got a follow-up question. In an S Corp with just one full-time employee owner, and then you have a situation where that one S corporation with the one employee has a part-time employee, which is the son. So great question. So first of all, if the part-time employee is not even a W-2 employee, let's say they're getting a 1099, then yes, you can still have the solo 401k regardless of whether they're your son or not. Let's say that it is a W-2 employee, but they work less than 1,000 hours per year or less than 500 hours per year for 3 consecutive years. So in that case, they're not going to be considered full-time. You can still maintain the solo 401k, whether or not they're their son, they are your son. doesn't matter. Let's say that it is your child. They are working as a W-2, but they are full time, so they're working, say, more than 1,000 hours per year. If they're under 21, you would still be eligible to set up a solo 401k. If they're 21 years or older, they would need to be at least a part owner of the company, at least a 3% or more owner of the company, in order for you to be able to maintain the solo 401k. If not, you're not going to be able to have a solo 401k because you effectively have a non-owner W-2 employee, which is going to preclude you from being able to set up a solo 401k, regardless of the fact that they're your son. So good question. So please don't hesitate to ask more questions. We're going to go through some more good topics here. So here we've got some great basics laid out. And some common questions. So the first highlight we want to emphasize here is that it's the same employer identification number for the plan. So even though you've got multiple participants, remember it's just one plan that's sponsored by the business. So it's just one employer identification number for the plan. So you might have one account at a brokerage in the name of the plan for the benefit of spouse number one. That account would be opened up under that plan identification number. The second account for the other spouse is also opened up under the same EIN for the plan. So that's really the second point here, is how it's separate accounts. Like we talked about, or we started to talk about with the good question, both spouses are going to have signing authority. So even if it's not a co-trustee situation, so the question was more along the lines of, you have a spouse that doesn't necessarily have self-employment income or doesn't want to participate, can they be added as a trustee so they can help administer the plan? And the answer is yes. They don't need to have that self-employment income to be the co-trustee. But if it's the latter situation, right, where the other person is actually reporting their own self-employment income, the other spouse does want to have their own account, then both spouses will be trustees. So it'll be a two-participant, two-trustee situation. So in that case, both trustees have signing authority. So technically, either trustee can sign on behalf of the trust. So let's say that one spouse is not available, but you need to make a time-sensitive investment. Under the terms of the trust, either spouse could go and sign on behalf of the trust to make the investment, regardless of the fact that you might be just using the one spouse's money. So the person whose money is being invested doesn't necessarily have to be there to sign, because either spouse could sign on behalf of the trust. Each spouse is going to complete their own beneficiary election forms, because really the beneficiary election form is at the participant level. So one spouse could say, I want to have upon my death, I want my 401k assets to go to a specific person or a trust, right, that my estate planning advisor has set up. And the other spouse might have your estate planning advisor might have set up a separate trust for the other spouse. So they want to have their assets go to their own trust. So they would complete their beneficiary election forms differently. So each spouse who's participating completes their own beneficiary election form. Now, another popular topic that comes up is with existing plans who later on want to add a spouse. So in that case, you can do that subject to all the good rules we talked about, right? Does the spouse, have their own self-employment income that they are reporting in the business? If the spouse is not already listed on the plan as a trustee, then the plan would need to be amended to add them as a trustee. Once they're added, and if the spouse has that earned income from the business, the spouse can have their own account. They could start making contributions. They can roll over money. They could take a loan. They can make investments, all the good reasons that the spouse wants to set up an account. And of course, a separate account would need to be set up for that spouse that's being added later. So that's something that we handle all the time for our existing clients. And so, we would guide you through the process based on the facts and circumstances. So that takes us to the end of the slide. If you want, or the end of the slides, thank you so much for your participation. Please don't hesitate to ask more questions. We do have a little bit more time. Feel free to also email us at business@mysolo401k.net. You can call us at 1-800-489-7571. Again, please ask questions in the comments if you're watching as a recording. Please like this video. Please subscribe for more videos like this. I see some more questions coming in. Are the rules impacted by filing taxes jointly versus separately? Great question. So generally speaking, it's going to depend on how the business is taxed, but generally speaking, it's not going to be impacted. The key is really just that each person is reporting their own self-employment earned income, and that you satisfy the other requirements, like not having any non-owner full-time W-2 employees working in the business. And thank you for the additional questions here. So what can be set up after year end? So I'm assuming you're talking about for 2020 purposes. So it is still possible to set up a plan after December 31st, 2020, but under the rules, the conservative approach is that you're only going to be able to make the employer contribution, assuming that the plan is set up on or before the business tax return deadline, including any timely filed extension, and the contribution is made before that same deadline. So next question here. So one more follow-up to the above. If the spouse is not part of the LLC but still wants to participate in the plan so that he or she can move the funds from a previous employer, can he do that? So I understand that you're asking, the way that I understand your question is that the spouse wants to participate in the plan. They're technically not an owner, which is okay as long as they are reporting their own self-employment income, earned self-employment income. So the spouse doesn't necessarily need to be an owner. The spouse needs to be reporting their own self-employment income to justify participation in the plan, and then would be able to roll over money and or make contributions, etc. Another good question, can the owner be planning administrator for solo 401k? So let's just to be crystal clear, the situation I think you're saying is that you have two spouses that are both owners, and you want to make one of the spouses the administrator, and the other spouse is going to be the administrator and the participant. So only one of the spouses wants to have an account, right? So the answer is yes, you can make the other spouse a co-trustee. That was our co-trustee only discussion a little bit earlier. So technically, you can make the other spouse a co-trustee even if they're not an owner. So in order to be a co-trustee, you don't need to be an owner. You don't need to report your own. I'm saying co-trustee only, meaning you don't have a participant account, but you want to have the other spouse have signing authority. So you can make your spouse a co-trustee owner, regardless of whether they have ownership in your business, regardless of whether this other spouse reports their own, self-employment, earned income. So thank you so much for all the good questions. Hopefully everyone found it helpful. Please like the video, like I said. Please subscribe for notifications of our weekly webinars. And thank you again.